Hey, what's up, everybody? This is Anthony. I'm here with Cory, and this is the first episode of the First Equity Funding Real Estate Podcast. We just wrapped the episode up. Cory, what do you think?
Short and sweet, definitely some good information in there.
Yeah, we really wanted to do an introduction episode, kind of let everybody know who we were, what we do, and kind of what kind of value we're trying to provide on this show going forwards.
Yeah, and right now it's a good little episode with just us, but moving forward, we're definitely going to have some guests and hopefully bring some really valuable content to everybody.
Yeah, I think I mentioned at the end of the episode, we're trying to do these episodes bi-weekly, at least, depending on when we can book guests and such. But I think this is going to be fun. There's really no podcasts I know of out there that are focusing on hard money and creative financing, as well as a host of other real estate topics, but nobody coming at it from that angle. So I think it's a good little niche in the market, and I think it'll be nice.
Yeah, it's going to be a lot of fun, and enjoy the episode.
And listen, we'll make them as entertaining as we can, and let us know what you think.
Sorry, take it home.
Yeah. All right, and we're on. I guess welcome to the first episode of the First Equity Funding Real Estate Podcast. I'm Anthony.
My name is Cory.
And we're with First Equity Funding out of Seagirt, New Jersey. And, really, I guess in the intro episode, kind of want to talk about why we wanted to start the podcast.
Yeah, do you want to kind of, talk about what podcasting is? I'm sure everyone listening kind of has a general understanding of what it is.
Well, believe it or not, I'm guessing a lot of our borrowers who we're going to be disseminating this information to probably are not familiar with podcasting. The easiest way to describe it, the way I would describe it, would be it's basically on-demand niche radio. Yeah. So it's typically a show that's about something very specific. In this case, real estate and creative financing, and it's on demand, meaning you download the episodes to your phone, you listen to them, on your phone or in your car, wherever you are, whenever you want, as opposed to radio, where if you want to listen to Howard Stern, you got to go on at specific times. So there's a lot of advantages in that way, and maybe for some of our borrowers and some of our clients who aren't as familiar with podcasting, this will be a good introduction for them.
Yeah, and the big difference, you can't pause Howard Stern and go back later, whereas this, you can kind of take a break, do what you got to do, come back.
Just in my own personal experience, I know some of the podcasts I've listened to that I found a lot of value in, especially real estate related ones. I've listened to that certain episodes 3-4 times.
Yeah.
So,
absolutely.
And it really runs the gamut. There's podcasts that maybe do news and updates, and they're 5 minutes long, and there's podcasts, that are 3 and 4 hours long. It's right. It's a very flexible and useful medium. So that said, we're going to have links on the page on our website, on the show notes page, basically telling you how to get the podcast. So you can either be watching on YouTube or download it via iTunes or Stitcher. And so if you have an Apple iPhone, it's pretty easy to subscribe to the show and then and get them right to your phone. And
like you said, it's a free-flowing, open form interview where it's just you can kind of get to the bottom of things, you kind of explore content a little bit. Today this is like introductory episode. We're going to talk a little bit about First Equity, what we do, hard money. But in the future we will have some guests, whether it be title agents or attorneys,
realtors, contractors. Any way we can add value, and I think actually going forward, that'll probably be most of the episodes.
Right.
Listen, obviously we're a lender. We would love to teach you about all there is to know about, creative financing, but we're really going to mix it up and provide as much content as we can. Yeah, so as far as today's episode goes, we'll just talk a little bit about kind of what we do and I guess what hard money is and how people use it to finance their deals, and then maybe touch a little bit on, we thought to talk about multifamily, because not everybody knows, but many people know that you use hard money for fix and flips, which is certainly the lion's share of our business, but more and more borrowers have been using it to fund their buy and hold their multifamily properties.
Yeah, which is something, that we love, funding those types of deals, the multifamily, bigger properties, so...
Yeah, and we've been doing it more and more, but you want to just tell a little bit about what exactly hard money is and how it's maybe a little bit different than conventional financing?
It's just it's a tool, to keep in your tool chest. It's just it's creative financing. It's more asset based, so while we do underwrite the borrower a little bit, it's mostly about the deal and if the numbers work. So we're, and like one of the partners say, and it makes a a whole lot of sense put in this perspective. We're lending on properties at their worst condition. We're giving cash for them to fix it up, and then the investor would then be flipping the property or refinancing it as a rental. I mean, it's only really two exit strategies, right?
Yeah, and there's a couple things there. So number one, if you're looking to do a fix and flip, if you walk into one of the big banks and tell them you want a loan to do a flip, you're going to get laughed out of the building, right?
Right.
So that type of financing is not even available. And then number two, for maybe other properties, if you want to buy a rental or something else that you could potentially get bank financing on, we have borrowers who, to a lesser extent, sometimes credit issues, we can be a little bit more flexible on credit because as you alluded to, it's more asset based and more experience driven. And obviously we review credit, but to a lesser extent. And then number two is self-employed borrowers. So a lot of times we have borrowers who have great credit, lots of experience, but they may not show any money on their tax returns, and that's an issue we can navigate around, whereas many other banks can't really work with that. So there's really countless situations in which using private money or hard money would make sense for you.
Yeah, and you'd be surprised on what you could do with creative financing. Whether it be private money, hard money. There's a loan out there for everybody. If you have a deal, there's money for it.
Yeah, that's always the big question, right?
Yeah.
Do you go get the money first, or do you find the deal first? And I think the answer really is both. You should be trying to source financing and source deals at the same time. But
Right.
at the end of the day, if you have a good deal, finding equity or finding the debt for that deal, I think, is a lot easier if you have a solid deal. So, and that's what we try to do. We try to identify borrowers who have experience, who have good deals, and just need some financing to get the thing done. So, you want to go over just maybe some general guidelines of how a fix and flip loan, sort of looks start to finish in terms of leverage and such?
So I kind of touched base on, I guess, how we do it. I mean, because we're kind of in par with the industry on how they do things, right?
If not, maybe
In
a
a
little bit
sense.
more aggressive than the average bear in this space, but
Absolutely.
so maybe we'll just talk in very general terms.
Yeah, so I mean, when you're looking for these properties, they're lending based off kind of two numbers. We're going to be looking at the purchase price, and then we're also going to be looking at the after repair value.
Right.
So with the purchase price, we're lending anywhere from 80 to 90% of the purchase. That's depending on borrower experience, the deal location, the size of the deal.
Maybe their history with us. Obviously, we can extend
Exactly.
better leverage to borrowers who have been with us for a long time or have done 10 deals with us.
Right, and most of the time, we're lending 100% construction, as long as it fits in the deal. And then when we look at the after repair value, we're lending up to 65% of the after repair value. And correct me if I'm wrong, some situation we kind of push towards 70%,
Yeah,
right?
if it's a larger deal and there's enough margin there, we can push that number to 70 or 75%, even in some cases. And just to unpack what you just said a little bit, it's important to remember if we're giving you, let's say, in the best case scenario, 90% of the funds you need to buy the house and 100% of the money you need to fix it up. We're giving you 93, sometimes 92, 93% of the total money needed for this project, and we're lending it on a property that's really in its worst condition. So it's a very, very aggressive loan from a lending standpoint. So not only is it financing that's not available from a typical bank, it's leverage that really is going to allow you to expand your business. Because as we know, if you're using cash, you'll find that you're going to run out of money very quickly.
Right, and because of that, what comes associated with it, and a lot of experienced investors understand this. They just calculate into the deal. It costs money to borrow hard money.
Sure.
And even if private money, it doesn't matter. You're going to be paying generally a little bit of a higher interest rate. You're going to pay some points at closing, but it's because of this, the risk that you're talking about, how much leverage we're putting in the deal.
Right. So if you think about it in the most simple terms, essentially we'll give you up to 90 construction, 90 for the purchase, 100% of construction funds, so long as that total loan amount doesn't exceed 65 and sometimes 70% of the after repaired value of the home. And again, that's why we can extend that leverage, is because we know there's that margin on the back end that you're going to make a nice profit. And you know this, we've turned loans down that the borrower is gangbusters to get this deal done, and we've said no because we didn't think the borrower was making enough money. Because the last thing we would ever want to do is put somebody in a position where we don't think they're making any money on a deal. Even if they were to flip the property and they broke even, that's not really the type of relationship that we want to establish with borrowers. That's not the experience we want them to have. So Most, and that's why we've been successful, because we've really satisfied, kind of what our borrowers were looking to do: get their property financed and have a profitable flip.
Right. And it's fresh in my head. Actually, it was a misconception I heard somewhat recently. Is that they think that we make a lot of money off the interest, and in reality, no. Like the faster, for example, to add that incentive, we don't have prepayment penalties. Obviously, in our eyes, the faster you get the deal done, the faster you can move on to the next one. The faster the next one we're funding, keeping the wheels turning is the goal. So we want to see you succeed and get into the deal, get it fixed up and sold, and so you
Sure.
can move on to the next one.
And there's been plenty of borrowers who sort of use these loans in different ways, and one of the ways is kind of using it as bridge financing. And so sometimes these loans are only out with us for 60 or 90 days. And so you're right. The fact that there's no prepayment penalty, you can turn over your deals really quickly, and there's no extra cost associated with that. But that's a little bit maybe more granular than we're typically going to get on this podcast. But we just want people to understand kind of what we do and where we're coming from. But really, with the point I think we want to impress upon people today is that if you've never looked at using financing, whether it's with us or private money or anybody, you probably should, because debt can be one of the most valuable tools in your toolbox when it comes to growing your business, expanding your real estate portfolio, and at the end of the day, making more money.
And I'm sure you could speak on that a little bit. You have yourself a couple of rental properties, and you're in the multifamily, game a little bit. As you said, debt and how important it is. Like,
Yeah,
imagine you had to buy those deals cash. It's like you can divvy that cash up in 4 or 5 different deals. Whereas in your case, you get some financing from a bank, and you're into 4 deals versus 1. You're over leveraged.
Yeah, me personally, I would never buy deals with cash. I think it's a waste of money. You can go out and get cheap debt from a bank, or cheap enough debt that it makes sense, and use the power of leverage responsibly to make more money. Especially if you're looking to do some type of buy and hold strategy, I would really never recommend somebody own a property with cash. Your returns are amplified when you put leverage, on a piece of property. So, just I have the most experience with multifamily properties,
And I want to correct. He's not just a little bit. I mean, you're pretty actively aggressive in finding multifamily properties.
sure, sure,
I know
and
you're not going to talk on it now, but you're the one once that deal done, tricky talk about it. But after that, you're on to your next one, right?
well, I'm under contract on a deal now, a multifamily
Yeah.
property, and if you look at the numbers, I mean, and not to get into multifamily on this episode, but cap rate is basically a return on investment if you were to pay cash without financing, and then your cash on cash return in a multifamily property is essentially after your mortgage. How much money are you making based on your money in the deal? And if you're buying right, your cash on cash return will be higher than what your cap rate is. And what does that mean? That means that you're making more money, and you're making a better return by using leverage.
Right.
So whether you're using traditional bank financing, private money, or hard money in this case, it's at least something you should be considering.
And the one most I would say what drew me the most to multifamily is the fact that once you pull all your cash out of that building, it means it's infinite return. I mean, you have no cash into this asset, and it's coughing money up, into
And
your
so
bank account every month.
right, so if you work backwards from what you just said, that makes hard money even more attractive, because if the end goal is to basically refinance down the road once you fix a property up and stabilize it and get your cash out, your goal should be just to acquire that property, whatever means necessary. If you have a great deal on your hands and you don't have enough money to go out and get, let's say it's a big apartment building, Fannie or Freddie debt, or
Right.
or even just put a local community bank, using a hard money loan to close quickly and get it done if the building has some warts, yeah, the rates are a little bit higher for all the reasons we just discussed. But guess what? Now you own that building. When you fix it up and refi and you pull your cash back out, that building's yours forever and you have no money in it. So that's a really powerful strategy, and it's one that we talk to a lot of borrowers about who are just doing fix and flips, and they're starting to realize that maybe the best strategy is to do fix and flips to live off of and make some quick cash, but eventually put that money to work long term and buy some rental properties, buy some multifamily or mixed use buildings as well.
Right. Some passive income, something that can generate income for you when you're not there. You don't have to constantly manage the construction projects, and well, it's fun. I see the investor having a lot of fun doing it, making plenty of money, but like I said, long term, you want to build that portfolio. And what you said was important was quick closings. With traditional banks, I mean, you're looking at what 30, 60 days to get financing sometimes.
Probably
And
more closer to 60 to 90 days,
yeah,
if everything's right. we're closing deals in 2 to 3 weeks, many times. Obviously, a bigger apartment building, maybe you're closer to a month, but it's way quicker than anything else you're going to get from a traditional lender.
Right, and there's a lot less red tape, I guess you can say, to cut through if you want to compare it to like a 203K loan, for example. Whereas, we're collecting, like 10 documents all together, on the hard money loans. It's a commercial loan, we're on looking at the property itself, what it's worth, and, mitigating our risk that way. Whereas if you go for a conventional loan, there's a lot that can go wrong, I guess. I mean, I've heard, situations where you're 2 days from closing, and for whatever reason the bank doesn't like it, and that's it.
Something happens,
Yeah.
and the loans got
Small
issues.
change in your credit or anything can kill the deal.
I always tell people that I think what we do is common sense lending. And you mentioned red tape earlier, and that's what all these big banks have, and it makes it can be very frustrating, not only for the people who are borrowing the money, but also for the people at the bank, right? Because everybody wants to move this thing forward, and for whatever reason, you just can't. And so if someone comes to us and they have a credit issue, or they don't show any money on their tax returns, or whatever the case is, maybe they're not quite as experienced as we want them to be, we can kind of put our heads together and figure out a way to make things happen and make things work.
Right.
So long as we think it's a good deal.
Exactly. And an example would be maybe giving like a little less leverage, or something along those lines.
Bring a partner into the deal,
right?
Which are things we can do quickly, as opposed to a longer drawn out process.
Yeah, it usually takes a couple days to get an answer. Usually within a day, but if we have a lot going on, it might take a couple days. But it's usually a lot quicker than going through the ranks of maybe a bigger institution.
Absolutely. So I guess the next thing is we kind of wanted to just touch on why we talk about what a podcast is, but why did we want to make a podcast? I mean, it's funny because when we get phone calls in the office from borrowers who we've never spoken to before, or potential borrowers, a lot of the questions are the same, right? So, we think we could provide some value here, disseminating information that is applicable to most people's situations.
Yeah, and not even talking about what we do, so we kind of have a place to, reference. We're hoping to add some value in terms of different content we're going to have. As we kind of mentioned earlier, title agents, attorneys, you mentioned realtors, just different perspectives of the industry that we're going to kind of have, somewhat, I guess, of an interview. I'm sure we'll have the partners in here at some point. We have not a loan officer that, so we're going to mix it up a little bit. And today, like you mentioned, was just more of an introductory of what we're going to do.
And I guess at some level it puts faces to the names. I mean, there's a lot of borrowers who I speak to on the phone regularly. We speak to via email, but may not know us. And it's important to know that there is a face behind the name, and that we're a small company, but we're pretty nimble and pretty active, and we're out there, and we're quickly becoming one of the most aggressive lenders throughout the New Jersey region, I would say. But we're lending across the country, and we just did a deal in Kentucky, and we're doing something down in Florida, and deals in Texas. So our reach has been we've been far-reaching as of late, and so I think we have a lot to offer people, and happy to share that information.
And as you said, a face and a name. I mean, I like to say we're a pretty trustworthy company. We try to look out for our investors, our borrowers. So I think, like you said, putting a face and a name can kind of add to that a little bit.
Yeah, I mean, there's deals, like we said before, we could have done deals, or we probably could have pushed deals through that maybe would have made sense on paper, but just something wasn't right, and so we nixed the deal because we thought that we were keeping our borrower out of a bad situation. And we've even had borrowers come to us later with other deals and say, you know what, you were probably right. That deal was not really what I thought it was, and
they appreciate that. Yeah,
they do.
Which
I think
that's good. It's always nice hearing that.
And we're pretty in touch with the industry, and as far as our loans, we write great loans, and we're really proud of that. We kind of do things in more of an old-fashioned way too. I mean, especially for our borrowers who are local, which is a far majority of them at this point.
Yeah.
We like to go meet people in person, right? We like to go have face-to-face meetings. We like to see your projects. We like to go out and see you on the job site, or meet you for coffee or lunch or whatever the case is. Whereas a lot of other people are in the office on the phones, and we don't really operate like that. We try to be a little bit more hands-on and approach the business from that angle.
And at least the added value, I'll sell the company a little bit, you get with First Equity is, combined experience. We got like 50 years in the office between the three partners. So perfect example is actually over the weekend, I have a deal in the, I guess you can say, Marlboro area. There's a lot of septic tanks out there. So one of the partners saw the address. He said, hey, do you want to give them a call and kind of run it past them? And I did, and they already did inspections and stuff. But that's something that can cost, that could be a $10,000-$20,000 fix. And we are talking about earlier, it can go up to $30,000-$40,000 real quickly.
Sure.
You're not trying to fix a septic problem. So
And
it's just that added experience, an extra set of eyes on, the projects that come across our desk.
Yeah, I mean, and just speaking on experience, I mean, we have a very well-rounded group here. I mean, we have people with experience from many different aspects of the real estate business, whether it's, from the Wall Street, more corporate side of things, whether from the conventional lending side of things. I come a little bit more from the multifamily background. So it's kind of like if you mix everything together, we're very well-rounded. And I think that shows because we can really provide value to our clients when they're doing their flips. And they've asked us questions that we've helped them get their projects done because we have that experience. First Equity has done their own flips along the Jersey Shore. And that's not to say we compete against our borrowers because we're in a very local market here on the shore, but we have the experience to be able to tell people this is what we did in that situation. This is what we would do. So it's one of the reasons I think borrowers like to work with us, on a repeat basis.
Which ultimately is why we're doing this podcast, at the end of the day, is to bring that value, bring the content. Hopefully, we can help somebody, move forward. And if they have any questions, reach out to us. So that's kind of what we're here.
So as far as, frequency goes, we'll probably be doing episodes, I would like to say bi-weekly, but
at least, right?
Obviously everybody's busy and we want to provide good content, so it's kind of dependent on when we can schedule guests and make that work. So I guess our goal is bi-weekly, and obviously if you're watching, you probably got notified of this by our email list, so you're going to get updates on new episodes that way, but I would certainly implore everybody to subscribe to the YouTube channel, which will have a link for on the show notes page, and also subscribe on however you get your podcast, whether it's iTunes or Stitcher or whatever other podcast app.
Yeah, by the time this is out, we should have all that set up already. So we should be good to go. Is there anything we want to add, I guess, for an introductory episode, or does that kind of cover everything we need to?
No, I think that's basically it. We're very proud of what we do here. I don't think we have to sell ourselves too much. We're always, here to provide questions. And like you said, our goal with this show is really to provide as much value as possible.
And answers to those questions.
What's that?
So you provide questions?
Provide answers to the questions.
We'll provide both. Yeah.
Yeah. So next episode we'll be back with the guest, and we'll be churning the episodes out. And please let us know if you like these, if you don't like these, if you think there's any format changes we should do. If you did like it, please give us 5 stars on iTunes or give us a thumbs up on YouTube. That certainly helps us, grow the show, and we're looking forward to it.
Yeah. Again, my name is Cory Anderson, and this is
Anthony Palmiotto.
And I think that's it. I think we're out.
We're out.
All right. That's a wrap.